adjustments for the final accounts. It means after the trial balance date, there will be some adjustments. So those adjustments have to be adjusted before the preparations of final accounts. As the first adjustment, we can identify closing inventory adjustments. As the second adjustment, we can talk about accrued expense. Third one, we can talk about accrued income. Then fourth one, prepaid expenses. Fifth one, prepaid income. Then sixth one, depreciation. And seventh one, disposal. And eighth one, bad debts. And ninth one, provisions for doubtful debts. So now we will see how to do these adjustments one by one. First one is the closing inventory adjustments. Closing inventory adjustment. So closing inventory is the value of the inventory physically available at the business warehouse, on the way, or with the agent sent on sales or return basis. So closing inventory value should be adjusted to the final account. Closing inventory adjustment is inventory account debit, income statement credit. Inventory account debit, income statement credit. So inventory account debit means it will be recorded at statement of financial position under current assets as closing inventory. And income statement credit means it will be minus from the income statement debit side. It means it will be debit to the income statement. It means not credit, minus from the debit side. So on behalf of crediting to the income statement, we can minus from the debit side to calculate the cost of sale. So that is the procedure of the closing inventory adjustments. Then second one, we will talk about prepaid expense. We'll see what is a prepaid expense. A prepaid expense. If an expense paid earlier, that is called as a prepaid expense. If an expense paid earlier, it is called as prepaid expense. So, if the expenses paid earlier, it will be a current asset. So, double entry for the prepaid expenses, prepaid expense account debit, relevant expense account credit. It means from the relevant expense it will be minus and it will be recorded as a current assets at the statement of financial position. So the next one, accrued expense. If an expense not yet paid, it means it has not been paid yet. If the expense is relevant for the current year, but it is not paid yet, then it is called as accrued expense. So if an expense is relevant for the year, but it has not been paid yet, then it will be a current liability. Then double entry, accrued expense should be credit. It means relevant expense account debit, accrued expense account credit. Relevant expense account debit, accrued expense account credit. Then accrued expense account balance will be recorded at the statement of financial position under current liability. and that amount will be added to the current expense amount. So shall we think as example, by now expenses, electricity expenses paid 10,000. They say another 2,000 is accrued. Then 2,000 will be added to the 10,000. Then total expense of electricity will be 12,000. So that is the accrued expenses. Then we will talk about accrued income. What is an accrued income? Accrued means it is not paid or received yet. Then it means income means it's not received yet. It is an income relevant for the current year but has not been received yet. It has not been received yet. Then it also current assets. Then accrued income account debit, relevant income account credit. That is the double. So accrued income account balance will be a current assets and the accrued value will be added to the currently available income amount. Then we will talk about prepaid income, or we can say that we can call it as pre-received income. An income has been received earlier. It means income may be relevant for the next year, but we have received in earlier. So if an income received earlier, it will be a current liability. So double entry is relevant income account debit, prepaid income account credit. Then prepaid income account will be recorded as a current liability and it will be minus from the currently available income. So by now we have talked about 5 adjustments: inventory, prepaid expense, accrued income, prepaid income. Then we are going to talk about depreciation. So this is a very important adjustments for the final accounts. So firstly we will see that what is depreciation. Depreciation of non-current assets. Depreciation of non-current assets. The assets value reductions as they are used in the business. So when the assets are used in the business, its value will be reduced, because according to the time process we are using it, and if it is a vehicle, how many kilometers it has been run, it has been used for. If it is a photocopy machine, how many photocopies has been taken. According to that, value will be reduced. So depreciations can be calculated using 3 approaches. It means straight line method, it means the cost value into the percentage, or reducing balance method or diminishing balance method. Then first year we calculate cost value into the percentage. Second year when we are going to calculate first year cost minus first year depreciation, then net book value is there. The net book value will be into the percentage. Another method is revaluation method. At the start of the year, asset is 45,000. At the end of year, value is 41,000. Then 45,000 minus 41,000. Then 4,000 is the depreciation. So that is the revaluation.